Mary Jane, lastly, Clearbridge.
Sure. So Clearbridge is an active equity manager. We have a history that goes back 50 years. We have about 130 billion in assets under management, and our headquarters is in New York City, but we also have offices in Baltimore, Delaware, and San Francisco. And 2017 marks our 30th year in ESG investing.
And Mary Jane, when you think about the sea of terminology, is there one that you tend to ascribe yourselves to, ESG versus SRI? How do you think about it?
Well, it's interesting. It's actually evolved over time. So when I started out in this business managing ESG portfolios, it was 21 years ago. And back then, we did use the term socially responsible investing, or SRI. What we found over time, though, is that there was a certain perception that SRI was about restricting or excluding what you don't want, or the sin stocks. And so there was very much a perception that SRI is equal to underperformance because you're excluding or restricting a big part of your universe. We changed our process from SRI to ESG, Environment, Social, and Governance, a number of years ago. And part of that was because there was a neutral objective association with the values of why it adds value from a stock selection standpoint of V, of S, and G, versus the word responsible and socially responsible investing, which had this overhang of underperformance. From the beginning, 30 years ago, we've always focused on the performance. It's definitely a very big part of our process. And so ESG lets our clients know that we are looking at each of those areas, because all of our companies, all of our publicly traded equities have some sort of impact of E, S, or G, and in many cases, all three. And that just gives more of an objective analytical approach, which is still thinking about stewardship, but not so much of a restriction approach.
Among those three letters, is there one that you're particularly interested or focusing on right now with the corporations that you're looking at?
All three are actually very important, and it kind of depends on sector. So in some sectors, the S, or the labor aspect, is very large. The supply chain, intellectual capital, retention of talent. In other industries, the E, like you were saying, E is very important because it's very much license to operate and what your impact is going to be and how you can create products and services related to E. But the G is interesting because it kind of goes across all sectors, and every company has the G, whether you realize it or not. It's going to be related to executive compensation, transparency of management board of directors, diversity of the board of directors and senior management, and accountability. So I'd say all three are important. G goes across the board. E and S are a bit more weighted depending on sector.
Okay, I want to stay on this performance tie-in, and Mary Jane, I'm going to come back to you. There is a general misconception, and perhaps it's starting to abate, that if you want to make an impact, you have to trade off some performance. Do you find this is still a persistent conversation, and how do you tend to combat it?
Mm-hmm. So we have clients who, when they think about ESG investing or making an impact, they have a certain mindset that it's not about the portfolio. It's about making as much money as you can through whichever types of investments, however those investments play out, and taking the proceeds or the excess return and writing checks to philanthropy. So they think that's making an impact. And with all due respect, that is a certain type of impact, and that's great that they want to support charity. However, we think they are missing out on the opportunity to utilize their investments also to make the impact. So double impact. The proceeds as well as what they're currently invested in. And what we found over time, and we've got a very long track records and various strategies to go back and observe what our experiences have been through the bull market and bear market, through different conditions and through different styles of how the performance can come through. And our experience has been that it's very much on the experience of the analysts, of the portfolio managers, of the strategy's history, than the performance of the overall portfolio, as opposed to that because it's ESG, it doesn't perform. We've in the active space, you see many managers who manage multiple strategies of different style boxes during different time periods, and they may perform or underperform, whether it's ESG or not. But when it's ESG, you almost get raised to a different standard where you have to perform on the impact as well as on the portfolio. We think that's fine. We've always taken the perspective that it's still an investment strategy. We are still taking your capital deployment for our products, and so we should treat it as a fiduciary and try to either perform as well or outperform the market as an active manager. And through our rigorous research process on the fundamental side, our stock selection approach, we've been able to outperform the market for a number of our strategies over 5, 10, 7, 15, 10, sorry, 3, 5, 7, and 10 year periods over time. And I think it's about the process more so than whether or not it's ESG or not.
Okay, interesting. So Mary Jane, how do you approach the measurement of impact in your portfolio?
So Clearbridge is a long-term owner of stocks. So our typical holding period, our average holding period is about 16 years, which is pretty long in our industry on the buy side. And this allows us to really get to know and understand and engage with the companies that we invest in on behalf of our clients. And our structure is that all of our sector analysts are responsible for the financial research coverage and initiation of many of ideas of the stocks, but they're also responsible for the ESG analysis and the integration process. So having the financial professional as well be the analyst as well as understanding the ESG issues really helps in our understanding of the companies from a long-term perspective. And so the way we would benchmark is the analysts will assign an internal ESG rating, and that rating, not too dissimilar from bond ratings, would be like an A, a AA, and a AAA. An A is a beginner, a AA is an intermediate level company, and a AAA is best in class. So our analysts who cover their various sectors, where E, S, and G will be weighted appropriately based on the companies and their businesses within those sectors, will assign the ratings of A, AA, or AAA. This indicates to all the portfolio managers when the analyst is pitching or making a recommendation that aside from the risk reward and the target price, this analyst is signaling to us that this company is an A, which means that it's a beginner company. So this tells all of us that this company is in its early stages, that there's going to be a lot of engagement and a lot of progress, and in essence, a lot of impact that can be had from this particular investment. But we also have situations where the analyst makes a recommendation and it might be at AAA, so it is best in class relative to its sector peers. And this signals to us that this is a high quality company. They are not only attractive from a financial perspective, but they're also very strong or leading in their industry on ESG or sustainability practices and how it's integrated into their strategy. So our analysts continue to engage the companies. They track all the meetings they have, and then they can watch the progress of a company going from an A rating to a AA rating. So this allows our analysts to upgrade or downgrade the company's ESG rating based on the company's progress. So sometimes companies make a lot of progress within a single year, and the analyst might upgrade the company, and that happens. And if the analyst does that, he or she has to write a note to everyone saying, I'm making an upgrade on the ESG rating for these reasons. On rare occasions, we do have a downgrade. And that, I think, is also signaling from a risk standpoint that, as Bill had noted, that understanding what the risks are related to the ESG profile of the company is also important, and that's when an analyst can downgrade it from a AA to a single A. There is an option that's a B, and that means it's inappropriate to own. And for an ESG strategy, so the analyst can actually downgrade it to a B, but that's very rare, and that requires everyone, the investment committee, to review such a downgrade. But the firm takes an ESG approach across the board, so across all strategies, all of our analysts and portfolio managers partake. I think there's very much a long timeline for us to measure different types of impact, and we've seen some events take place or some progress takes place that it's very short term, so within a year they make a change and we want to note that impact, and in some cases it could be 10 years that it causes the company to finally make that change. This is all positive in our view. We don't take an activist approach with a big hammer. It's more constant communication. We're in the best interest for them to communicate what we think they can do, the companies, in terms of improving. And they also are helping us in understanding what they're doing to improve. So that communication is very collaborative, but also we have to be independent as well. If we see something that's not working out, we need to communicate that as well.
Interesting. So you have your own internal rating agency for impact as well.
In a sense, and then we benchmark externally to what other companies rate.
When you think about how you measure impact in your green bond strategy, what's the metric that you use?
It's actually a very, it's one of the most commonly discussed topics is measuring impact. And we're paying a lot of attention to how to best measure impact within public equities, and I'm sure you are within fixed income and you are with your own corporate. But it's a challenging area because there's lots of different ways to do it. Do you do it by resources, like the amount of water and the number of carbon emission by ton? Or do you do it by the Sustainable Development Goals, which are the 17 goals that the UN issued, and it covers everything from poverty to gender diversity and so on. And it's kind of trying to make that concrete is a bit of a challenge, and I know that in our discussions with our asset manager groups that we work with around the world, this is an area that's a priority for us because we've gotten past the point that you can construct a solid portfolio for an ESG or an impact investing client. We've fortunately started to pass that point. People are accepting that good performance can happen through long-term views on ESG investing in portfolios. But the next level that everyone's now looking at, particularly clients, is, well, what impact are you having? It's great that you've got a well-performing portfolio, but what impact are you having on society? And that's where we're all talking about, which I think is very timely.
Now, it's interesting that you've brought up the client because I want to bring our attention back to them, and I'm going to pull up a graphic that I saw on Bloomberg not so long ago. It was titled Voting Dollars, Ethical Investing is Gaining Adherence. So here you're looking at assets in socially responsible U.S. mutual funds, or ETFs, as some of you have here. Is impact investing a fad, or is it something that you find clients are saying, this is here to stay and it's not a niche part of my portfolio, it's the core?
It's funny, there's been a couple of reactions once changes in administrations, and we've had changes over decades, and not just the most recent. Some say, oh no, we're in trouble, all the forces of good and administrative acts are going to possibly be undone from an environmental standpoint, or issues related to immigration and migrant workers. But then we've also had the other reaction where, oh, thank goodness, I'm going to invest in ESG instead of being instead of giving up and saying, is there any hope for us? We're going to actively seek out ESG investing because it's in line with what I'm thinking. Many of our clients are saying this from a long-term perspective. And the marketplace over multiple administrations, like many of your projects, can be fickle and can be very difficult to win over. It's challenging to win over. So I started 21 years ago. And many of the actions that have taken place in the past 5 years are relatively new, and much of the reaction in the marketplace has been, oh, this is new. And for many of us, we're like, it's not really new, it's just we're waiting for you to catch up because education is such a big part of it. And as what we've seen, as far as is this a trend? Is this, with the political winds, does it go out and come back in? What we've seen is that once they're in the know, once the clients, institutional consultants, pension administrators, CIOs, CFOs are aware of this thinking that you can incorporate sustainability factors into your long-term investment view without necessarily hurting performance, and if you may have a positive impact in doing so, that it's hard to turn back. It's almost similar to climate change in the sense that as more nations, as well as individuals and citizens, are aware that climate change is something very real and something very serious that we have to all start thinking about, whether it's conservation or a choice of vehicles or how often we turn the lights on, that all that comes into play, and we can all do so much, and it's just a matter of time. But now that they're in the know with climate risk and climate change, and they're in the know with impact in ESG investing, we found that if anything, they tend to stay, and they stayed for a long time. And we've seen the actions of multiple parts of the investment chain all respond, and we don't think it's necessarily going backwards.
So Mary Jane, moving over to Clearbridge, talk to me a little bit about your engagement approach. You mentioned this internal rating agency of sorts that you have, and that these companies can really move in terms of their impact rating. So how do you engage with them? Can you give us any examples of times when you've brought someone from that A rating to a AAA?
Sure. So all of the engagements are led by our sector analysts, who are responsible for covering that particular company. The analysts will typically bring the CEO or CFO to our office. The analysts will go over typical traditional financial discussions that may be the subject matter of the meeting, whether it's dividends or whether it's growth of earnings or strategy or change in management, whichever, covering the quarter. But they will also bring up issues around environment, social, and governance as it's relevant to that particular company. So we've had one company that's a biotech company that our healthcare analyst had been engaging with the CEO for, I want to say 8 to 10 years right now. And it's been a long-term holding for us. And the analyst brought up that there's no reporting or transparency around sustainability. The analyst brought up that we have no idea about product safety protocol in reporting, and what management's view is on long-term sustainability for a biotech company. And through the multiple meetings over the years, The company has increased their reporting, has been terrific stock, but also has been a really great reporter in terms of disclosing their activities, which helps give additional level of confidence to our analysts that this company is more of a best in class relative to all the biotech plays within his space. And the company went on to mirror the progress they made in their Denmark location, where they eliminated 97% of the waste in that one plant, and then they replicated that progress to all the other plants and have reduced their amount of waste by a tremendous factor. And so each of those areas, which in and of itself may not be a significant driver of whether or not we should own the stock, each of those areas contribute to the overall long-term competitive advantages that that company can have, and that they showed it to us. That's a big part of it. What we find is sometimes the hidden jewels that companies are doing great things on sustainability, and they just keep saying, well, no investor asks us, no investor asks us. So when our analysts will ask, or the PMs will ask, they say, wow, we've been doing this, but no one's been asking us. Here's all that we do. And that is really helpful. And that might help a company that was an A initially jump to a AA, because all this information is now coming out. But we've seen that across each of the sectors, and whether it's a Costco or a Whole Foods, companies that you think are kind of leadership in sustainability. Many people may not have recognized Costco as being, they say, oh, Costco, that's where I go and get all my supplies for the week or for the month or 2 months.
So I buy in bulk for anything.
Yeah, giant vats of toilet paper and cereal for the next year. But it's also one of the best employers. So analysts have spent a lot of time with them on minimum wage versus living wage issues. When you think of retailers, you think of SG&A expense, and one of your biggest contributors are your workforce and the people in the stores. And what he's found is that the company is typically, on average, $21 an hour for the employees, which is way above the $7.75 minimum wage. And so Costco has been, again, another terrific company for us as an investment, but it's one of the leaders in terms of labor and wage and medical benefits, high productivity, low turnover, very loyal customer base. They have very low SKUs, so their number of SKUs, so their workers are spending more time face time with the customers, as opposed to stacking the shelves. So that type of business model and that activity is something that our analysts honed in on and continues to ask the company. So when you also think of Costco and other large retailers, you think of who's buying all this stuff and can they have influence. So our analyst was talking to them about their work with migrant workers and tomato farms in Florida, and this treatment of and the hourly pay of those migrant workers, of how they're being treated in terms of overtime and proper pay and a day off, and not getting sick, and that all contributes to the sustainability of the supply chain, which makes good business sense for a company like Costco as well. And then when we think of our seafood, much of our seafood is coming from Asia, and much of the process of how it's sourced, harvested, and overfished is not necessarily sustainable. And the laborers are not necessarily treated sustainably. So a company that has a huge buying power, like a Costco, can reach out and say to their suppliers, we want you to treat your workers better. We want you to be sustainably sourcing your seafood, so maybe you shift from one stock to another stock. And that, again, contributes to the behavior. So the fact that our analysts, regardless of which company, are continually reinforcing their interest in these sustainable practices, again, competitive advantage, supporting the thesis of the investment, this is how our analysts think about it.
That's so interesting, and definitely reinforces the point that if you invest in these companies, you are making an impact just by the way that they're changing their governance models to impact their end employees or the farmers, as you mentioned. Mary Jane, help us to understand how investors can make an impact through public equities.
I think public equities are probably one of the most underappreciated asset classes for making impact, and it's probably secondary to the other underappreciation asset class, which is fixed income through, say, in this case, green bonds. And what's interesting about public equities is that it's the second largest asset class. It's highly liquid. So you can get in, get out of it. You can have a diversified portfolio, so it's not just project by project. And importantly, you can have very large scale. So if you are investing in large corporations as well as mid and small, what change you can make in that corporation's policy or practice, either in governance or labor or environmental related, can be huge in terms of scale. So much bigger impact in that sense. We are seeing more of our clients coming forward saying, wow, I always thought of public equities as just generating returns, and then my philanthropy is on the side for impact. But now they're saying I can do both.
When you think about how Clearbridge falls into a larger investment portfolio, how do you think about your value add? And do you see that, generally speaking, your investors are starting to make ESG considerations more mainstream in their investment decisions?
Well, we have a long history of clients who've come to us for our various separate account strategies and our mutual funds. And what we found is that they've come to us because they're very interested in the investment strategy. And then more and more clients are finding out about our ESG integration and approach as we educate our clients on ESG. And what we've also found is that for what's interesting for many of our clients is that there are lots of themes that we can look at from a long-term perspective. So many of those themes might go under E for environment. And when we're thinking about our portfolios, we're not just thinking about the theme, like renewable energy or lighting, for example. We're thinking about what's the investable idea and how can we capitalize on that theme to bring a stock or an investment into the portfolio that can benefit our clients who are long-term investors. So when we think about renewable energy, there are lots of reports coming out about the future of power supply. And many reports are saying that the growth of renewable energy is expected to match, in a number of years, match the pace and growth of gas as a fuel source for the power stack supply. And so rather than sitting on the sidelines and saying, well, should we just buy gas? We're saying, let's look at renewable energy companies. So we own companies like Vestas. We own companies like a BEP, Brookfield Renewable Energy Partners. And these are leadership companies in the renewable energy space. So we're trying to find companies that are supplying that at a time that the growth and commitments to renewable energy are going higher. So like you said earlier, is the change in political environment going to reduce that potential? And what we found by investing through public equities as part of your asset allocation is that the corporates and many of the corporates that we invest in are actually the biggest committers or the biggest buyers of renewable power for their operations and buying into the grid. And so here's a situation where the corporates are outpacing the states and federal policy, which is great for us as investors because we're participating in that. Lighting takes up 20% of global power supply. So lighting is a huge part of global electricity use, about 20%. LED lighting, we know, reduces the electricity use by 30%. And we're only at, we meaning the LED lighting market is only about 10% of the market right now. So the potential for growth from 10% and above, and the reduction of energy use as a result of using LED lighting is another way that we can capture that theme and bring it into an investable idea. And that's through a number of LED lighting companies that we've owned for a long time at the firm.